Hey, this is Keith Weinhold from the Get Rich Education Podcast. You are listening to my friend John Larson in the Real Estate Cowboys. Don't quit your daydream.
Hey everybody, it's Robert Helms, host of the Real Estate Guys radio show, and you are listening to the Real Estate Cowboys.
Have you thought about becoming financially free through real estate investing, but don't have the time or knowledge to get started? Welcome to the Real Estate Cowboys podcast. Each week, we discuss passive income investment opportunities in the red-hot Texas market. John Larson and the Real Estate Cowboys will show you how to leverage their team to build wealth in real estate through passive investment opportunities. And now, here's John.
And welcome to the Real Estate Cowboys podcast. This is your host, John Larson. This week, we are going to be discussing some tips for beginning real estate investors. And I have 8 tips for new investors out there. And just to reiterate what we talk about just about every week on the show is, investing in real estate is definitely one of the smartest moves you can make. Whether you're investing in single family homes for yourself or to use as a rental property, or buying multifamily residential properties, duplexes, fourplexes, apartment buildings. It can be a very safe and stable investment for you if purchased in the right market and neighborhood. That's very, very important. We talk about that all the time. If these investments are not purchased in the right market or neighborhood, they can quickly turn into very large headaches. Trust me, I've been down that road numerous times in many different markets, got talked into buying C or D class properties, and it doesn't matter what market it is. If it's a C or D class property, it just doesn't work, and it is anything but passive. And myself and my investors, we're all looking for passive options. We understand rental properties are going to have some problems here and there, but the idea is to mitigate those problems. Not have to constantly be chasing your tenants down for rent, not having outrageous turn bills because your tenant trashed the house, not having to worry that when your property's vacant, someone's going to break in and steal your appliances and your hot water heater and copper piping out of the walls and so on and so forth. Or someone squatting in the property and having to evict a squatter. It's just it can be a very big pain. So like I said, very important that you pay attention to the market on a macro level and the neighborhood on a micro level to make sure you're not buying these low C, D class properties that are just going to be nothing but a headache. The idea is to preserve your capital. Hopefully the property appreciates in value. If it doesn't, some neighborhoods where you have the B class homes are not going to be those high appreciating areas, but at least you can attract and consistently attract good tenants that are going to pay your bills for you, right? So you're not losing money. That's the goal. It's definitely smart move to plan for retirement using a mix of different investments. And, we talk on the show about the benefits of real estate versus the stock market, but it's smart to diversify into different investment opportunities, right? Actually owning a single family rental portfolio or a multifamily property, and then dabbling in some private lending and also, playing with the stock market and sticking some money in some mutual funds or annuities where it doesn't really do much for you, but it could preserve your capital until you can find a better option out there. On our latest private lending opportunity, we're going to be doing 12%. That's the highest we've ever offered. So how many other options out there are getting you 12% fixed in a very passive manner, paying you a monthly dividend that you can account for each month? You know what you're going to be making to the penny, backed by an actual real estate property, and you holding first lien position. It's a great, great option. So definitely a good idea to diversify your money among a lot of different things. I have family that really just invest in the stock market, and I keep trying to push them into some real estate opportunities. Not even mine. I try not to put my family's money unless they come to me and specifically say, I want to invest in your opportunity. I don't pester my family and friends into investing in my deals, but we have some really, really good opportunities and some great ways for beginners to get involved in real estate. And so another thing that differentiates real estate from the stock market is, with real estate, you always have a physical asset to show for your expenses, and its value never goes to zero, which is very important. How many people, let's see a show of hands out there in radio space, how many people lost money recently in the stock market? Guarantee there's a lot of people that are raising their hands. Lately, the stock market's been very volatile, And so it's really not the best place to park your money right now, in my opinion. The fact that real estate never goes to zero is very important in my eyes. It's always worth something. With stocks, company could go out of business, the CEO says the wrong thing, some bad publicity gets out there, and all of a sudden you see a free fall with the stock. That's not something that I feel comfortable with because I can't control it. And so with stocks, it can go to zero. Okay, you can lose all your money. And so with the stock market, you have to be very careful. Now, another thing with real estate is you can insure it, right? To prevent any loss from outside factors that are out of your control. Storms, flooding, things of that nature. You can insure the assets so you can recoup your money. It's important. I really like that about real estate. That you can't get with stocks. And so real estate investing for a lot of beginners out there, it can seem overwhelming, but it doesn't have to be if you do it the right way. And just like anything that you first start, there's going to be a learning curve involved when you're navigating the real estate markets out there as a beginner. But there are definitely some steps you can take to get started to minimize those mistakes. And the first one I would say is don't rush. You have a lot of investors that get excited. They go take a class. They join, any of these little guru out there, the guru programs, and they're ready to just go buy. They're super excited. And it could definitely be tempting to jump into a purchase, but you should definitely take your time, especially when you're starting off. As a new real estate investor, you'll want to really understand market conditions, how much properties are renting for, how they hold their value for resale, and neighborhood factors. Is there a lot of crime in the neighborhood? How long are these rentals sitting on market? That will give you an idea of what the demand is like in these areas. Also look back on some historical data, right? History is our best teacher, in my opinion. So going back and looking, did rents drop in this area in downtimes? Did property values, how much did they drop in the previous recessions that we've seen here in the U.S.? So go back and look in 2008 and 2009, what were these properties worth? I think that's a great way to start mitigating your risk on the buy side and not buying yourself a lemon. That's just going to suck money out of your wallet and your bank account. You might want to look at up to, 100 properties before you decide to buy one. It's a big decision and commitment, so you definitely want to take your time. And you want to analyze different markets. We talked about a few weeks ago that DFW is back up there as number one by a lot of publications that are circulating in the U.S. and a lot of research that's been done forecasting the 2019 real estate market. DFW is on the top of many people's lists as a great place to invest for a lot of reasons. The main one would be the job market, the diverse economy, and then the affordable cost of living. And then those are probably the three biggest reasons why you continue to see the real estate market in the Dallas-Fort Worth area explode. I'm super excited about the office building that we just purchased in Carrollton, the North Dallas area, 30,000 square feet, 90% occupied. It's going to be cash flowing really solid for us here. And we're about to start going in and doing a renovation. And we have some expiring leases coming up this year where we're going to be pushing up the rents. So there's a lot of meat on the bone, so to say, to continue or to improve the performance of this property. And I'm not really worried about keeping it occupied because it's in a great location of Dallas. And it's in the Dallas market. So on a micro level, it's in a great area, very sought after area for businesses right near the tollway, right near the Addison Airport. And it's on a macro level, it's in the city of Dallas, which is the home to the most corporate headquarters in America. And I don't see any signs of that slowing down. So number one, don't rush. I think that's smart for anyone to consider. You run in, jump into a property and it ends up being in the wrong area and it's not attracting good tenants and, then goes vacant, gets broken into. It's just not going to work for you. Or it's in a market that's susceptible to downturns and you just paid $120,000 for a property that next year is only going to be worth $65,000. It's happened. And everyone could say, well, I plan on keeping the property long term. Well, you don't know what could happen with life. You could lose your job. Your wife could lose their job. You don't know. And then now you need to liquidate some of your assets. Well, you just paid $120,000 for a home that's now only worth $65,000. You're going to be upside down in that mortgage. You're going to take a loss. Be very careful. And that goes into knowing your market. Number two, don't just rely on a real estate agent. Real estate agents are salespeople. They're trying to make money too. A lot of estate agents out there are just going to try and, paint a pig and tell you it's the best thing since sliced bread. And you take their word for it. And then you find out that it's anything but what they promised. That is not something that you're going to want to jump into either. So you need to know your market. A lot of investors from California, they can't invest in their own backyard. So they look for other markets in America to invest in, other states. Some investors in California invest all the way in Memphis or all the way in on the other side of the country in Alabama. Know your market. Just because the numbers look good on paper does not mean it's a great investment opportunity. There's homes everywhere. There's markets, hundreds of markets to invest in. Know the market that you're investing in first. Do the due diligence. When things weren't going good with the economy, how did those markets look? Were there people moving in? Were there people moving out? Did it stay pretty stable? You need to know these things. Because when things go bad again, not only could the value of your property drop, but maybe people are fleeing that area and going to other places like Dallas where the economy's good, right? Because there's no jobs in these areas when the economy isn't doing well. So you need to know that before you invest in these properties. You want to know the values. You want to make sure that you're not overpaying for a property just because it's quote unquote turnkey. You don't want to overpay. And it's okay to overpay a little bit for the service that was provided to you, but not grossly overpay. You never want to do that. You never want to put yourself in that financial position. Another thing I would consider is looking into a REIT. It's a great way to just kind of get your feet wet. Real estate investment trusts. Buying into a REIT allows you to invest in real estate without actually getting the physical property. REITs are sort of like a mutual fund. It's very hands-off. Companies that own commercial properties, such as office buildings, apartments, hotels, retail stores, they give you the opportunity to invest in that company that's going out there and gobbling up these properties, right? And a lot of times they're willing to pay a pretty high dividend, 8%, somewhere around there. And it could be a good choice for you. And it's a way to diversify, right? It's a way to get your money passively working in real estate. But it's not really going to teach you anything about real estate. And you're not going to be the sole owner of these properties. It's going to be tons of owners, right? Thousands all invested in this trust. And like I said, it doesn't really give you the opportunity to learn. So if you want to remain a beginner, look at a real estate investment trust. But if you want to further your knowledge in real estate, maybe park some money in there just to kind of diversify it out of the other traditional investments that are out there. But, because your money will still be working for you in real estate, but it's not really going to teach you much about investing in real estate. And the real money is made in, being able to analyze good deals and get your money working for you in the best, but also safest opportunity, right? Something that matches your risk profile. Because generally, of course, high returns are really going to come with a lot of high risk as well. And so you want to be able to look at these deals from an educated standpoint. And you're not going to be able to look at deals with that standpoint and viewpoint unless you've done deals yourself. Okay? Because it's easy to sell somebody 18 months, 12%. But how do you know you're going to get your money back? You need to dig into the deal and make sure it's seems safe to you, right? You can see how you can get your money back out of the deal. And like I said, REITs, great passive way, great way to diversify your money, but it's just so hands-off that it's very hard for you to learn. You're not specifically investing in this specific office building and looking at the rent roll and looking at the comps in the area and so on and so forth. And, looking to see what the absorption is in the area and looking to see what are other buildings in the area renting for and what did they look like and how recently were they renovated and is there room here to push rents up. You're not going to be looking at all that stuff. The trust, the real estate investment trust, is going to be handling all the dirty work. You're just going to be providing money for a fixed return. Good option for a beginner, but not a great way to advance beyond a beginner. The fourth thing I would say is to invest in rental properties or a turnkey rental. Now, a turnkey rental is great because it's going to be a rent-ready home. A lot of times it's already comes with a tenant. There's a tenant in place. So when you purchase the home, you start cash flowing from day one. In most cases, you're going to have a property management company that's looking after the home for you. Now, although it's still hands-off, so to speak, there's still going to be a review of statements. There's still going to be some conversations with your property manager. So you're going to start to learn what it's like to be a landlord. You'll learn about vacancies, how long it takes to turn the property, what costs are associated with turning a property, reviewing applications from prospective tenants, things of that nature. So it's a good way to get in to building a rental portfolio and start generating some income from rental properties. And it's also a good way to advance beyond just a beginner because you are going to have to spend some time on this property. Also, when it comes to tax time, conversations with your CPA, saving receipts, things of that nature to, take advantage of the write-offs that are available to you, learning about the write-offs that are available to you, which are outstanding. get the best write-offs, I believe, by owning property in the U.S. And the government set it up that way because they're all real estate investors themselves. So you see a lot of loopholes with owning real estate to offset, paying high taxes, okay, or paying high income taxes on the money that you generate from the properties because there's so many write-offs available to you. Now, there's another way. You see a lot of investors, if you follow Bigger Pockets and things like that, you could do something called house hacking, which is occupying an investment property and renting out rooms in the property or living in one of the units while renting out the rest. A lot of investors look to get a duplex, right? It's just tough to find really good duplexes that cash flow in good neighborhoods where a lot of investors want to live. But it's a great way to kind of get your feet wet and get started. You can be the landlord because you're just collecting rent in a property that's next door. So you can kind of learn what goes into being a landlord and what goes into owning a rental property. And it's a great way to kind of offset expenses for your own residence, right? So house hacking is a great opportunity to kind of get in and get your feet wet as a beginner. But I do recommend buying turnkey properties at first. Just make sure your expectations are set correctly. Turnkey doesn't mean you're never going to have any problems with the home. There's always going to be problems. What I've found in my career is with A-class homes, there's less problems versus C-class homes where you find more problems, but also A-class homes, they cost more. The numbers don't look as pretty on a spreadsheet, but they're probably more accurate in what you're actually going to see. And they'll also give you the opportunity to see income or possible profits from appreciation, whereas C-class homes don't really appreciate. And in my history, in my career, I found that my A-class homes were my best performers when you group in the money that I've made off of through appreciation. And by refinancing the homes or selling the homes and making that equity in that property tangible. That's 1 through 4. I have 4 more tips that I want to give my listeners. Just let's take a quick commercial break. And we come back, I'll go on to 4 other tips for beginning real estate investors. Stay tuned.
Looking to complete a 1031 tax-deferred exchange and are needing financing for your replacement properties? Let Graham Parham at Highlands Residential Mortgage guide you through the process and make your 1031 exchange go smoothly and on time. As a seasoned investor, Graham owns several investment properties himself, and he can share with you the best way to plan your exchange. Graduate into a better property or properties and make use of leverage to obtain better cash flow and higher returns on investment. Highlands Residential Mortgage has one of the best in-house loan processes to deliver your loan on time and without any surprises. We are 1031 exchange friendly. Call Graham's toll-free direct number today at 855-326-6802 for your free mortgage consultation, or visit us online at texasinvestorloans.com. Highlands is an equal opportunity lender, NMLS 195724, located 1201 North Central Expressway, Dallas, Texas, 75234. Highlands Residential Mortgage, NMLS 134871, is not a financial advisor.
And welcome back from the commercial break. This week I am providing 8 tips on real estate investing for beginners. And we've just got through 1 through 4, and we have 4 more. So let's just jump into it. The 5th one is to start small. Start off, it's okay to start off with just one property or a duplex or a multi-unit property that has only a few units. Just get your feet wet. Don't get in over your head right off the bat. As you get more experienced, you can buy more real estate and get more involved, but don't burn out too early. And I've seen this happen with a lot of investors. They have some extra money. They want to take advantage of the tax benefits that are associated with owning real estate. They want to start earning income. They want to start supplementing income. They want to build towards retirement. And so they just jump in head first without really knowing what goes into owning rentals. And so they buy 5 or 10 right off the bat. And a few bad experiences can really sour the entire venture for you. And then you have a moment of, what did I just do? And then you're scared of ever investing in real estate again. Trust me, so many people have been successful in real estate, but so many people have been unsuccessful as well because they just jump in too fast, or they take someone's word for it, or they go into it with the wrong expectations. And so when you go into anything with the wrong expectations and it doesn't work out the way that you thought, you instantly become soured by the whole thing. But then where are you going to put your money? What, are you going to go back to the stock market and play that game? If you invest in real estate right and you buy the right properties and you're working with the right people, just know you're still going to have some bad experiences, but overall the good should outweigh the bad. And so the last thing I want people to do is just jump in and buy too much, spread themselves too thin, because I'm telling you, you are going to have some experiences that you're not going to like. And if you go buy a bunch of C-class homes because it looks like, wow, I'm only investing $500,000 and I'm making this unreal return, it's just not going to come to fruition. And then it's just going to put this bad taste in your mouth. And you're going to have these vacancies and these break-ins and these thefts, and, your property is going to go down in value. And then you're going to want to go sell them. And then you're going to be like, oh my gosh, look at this. I'm selling all the houses for $20,000, $30,000 less than I bought them for, because now they're not quote unquote turnkey anymore. They've had some damage. They've been broken into. They're not, rehab to sell on the retail market. They're probably not located in an area that has a lot of retail demand. So you're just selling to another investor who's going to want a deal. Right? They're going to know that you're in a distressed situation. You're desperate to sell, and they're going to say, here's my offer, take it or leave it. And a lot of times you'll be, forced to take it because you just want these properties off your hands, because they start to grow tails. We've talked about this before on the show, and it's hard to cut these tails off. And the longer you leave a property vacant and sitting out there, the greater the risk is that it's going to get broken into and there's going to be some damage to the home. And just over time, if a property sits, it's going to incur more and more problems and more damage, and it's going to cost more and more money, right? Just to keep the house maintained while it's vacant. Starting small, I think, is definitely a good thing. Start with 1 or 2 properties. Start with, a duplex. Start with a small multifamily property and see how it goes. And just understand that you're learning. You might find that, hey, this C-class property looked good on paper, but, it's just not passive enough for me. Maybe it still made money, but it was just a lot of problems, a lot of conversations through email or on the phone with your property manager that you just don't have time for, or you just don't want to be bothered with. You see that it's generating some money and you like the tax benefits that are available to you and so on and so forth. So you decide, hey, I like what I'm doing. Maybe I just won't buy as many C-class homes. I got a good base of C-class. Maybe I need to look to buy some more higher B to A-class properties, right? Something that will provide a little bit more of a hands-off experience. But you won't know that until you kind of learn and take a small sample size and learn from it. The next tip I would give is to, this isn't generally the most passive thing, but consider flipping a house. And I would only do this if you have some extra money, some money that you're able to lose, right? But it's a great way for you to learn to what goes into renovating these homes. And trust me, it'll give you a greater appreciation for these turnkey providers out there who renovate hundreds of homes a year, or even if it's somebody that only renovates 20, 30. There's a lot of work that goes into it. There's a lot of money that goes into it. Through, renovating your own house, I would practice on a very inexpensive property, and it will teach you what goes into the renovation process. It will teach you what to look for on the inspection reports, what's serious and what's minor. It will give you an opportunity to understand, are there some areas where I can cut corners? A lot of time investors want to overdo it on the rehab when it's a rental and they're putting too much money into things that are going to have to be replaced in the short term. And that's why their turn costs are so high. But you won't really understand this unless you try one yourself. And so you watch HGTV, you see flipping homes can be really lucrative if you know what you're doing. Purchasing a home at a low price, fixing it up, and then selling it for a profit, it's not as easy as it looks. It's a big thrill. It's like, wow, look at this money I made on this flip. And it gets a lot of people jazzed up. But trust me, they make it look really easy for TV. There's a lot more risk involved with it than you think. There's a lot more moving parts than you think. You always think you're going to be able to sell it at a certain price, and then when it gets to market, you end up having to sell it for less than you thought. It's very rare that you hit that target price that you planned on selling the property for, and a lot of times rehab budgets go over, and so it's good to practice on a small one, right? And like I said, though, don't do it unless you have the money to lose to do it, but it's a great way to understand the ins and outs, okay? So I do kind of recommend that for a beginner that has some money to kind of play with and learn with, right? So if things go wrong, it's not going to keep you up at night that you lost that money, but it'll really, really accelerate your knowledge when it comes to investing in real estate. Just even dealing with the real estate agents, the contractors, the buyers, the inspectors, the appraisers. It's a great, great learning experience. So I would definitely consider that, like I said, on a small project, something that's not very costly. And like I said, only play with that opportunity if you have some money to lose, because I cannot guarantee that your first flip is going to be an outstanding success. It's very, very difficult to flip homes and get the profit margins that you planned on getting. And it's difficult. It's a moving target. The other tip I would give is maybe look at a vacation rental. I know a lot of friends that they bought their first rental was a vacation home, something that they used from time to time. And when they weren't using it, they had a property manager that was leasing it out for them. And they were generating some income through a vacation rental or an Airbnb, right? That's another good way to kind of get your feet wet and understand what goes into owning a rental property. And like I said, with a vacation rental, it can serve multiple purposes. It gives you somewhere to vacation, but also provides you with income to pay for that vacation. And so you can purchase a vacation home or a condo, live in it for part of the year, rent it out for the rest of the year, or just purchase it to do an Airbnb, VRBO scenario, right? Or you hire a property manager, like you buy something in Myrtle Beach or in Florida, right? And you can hire a property manager that specializes in short-term rentals. And the return can vary. It depends on what type of property it is, where it's located, so on and so forth. Sometimes, though, the barrier to entry can be higher with vacation rental homes because it's a beachfront property or it's in a vacation destination. That can usually come with a higher price tag. And it can also be a little less passive when you're dealing with the day-to-day operation because it's a short-term rental. So you have people coming and going more frequently. That can also cause higher maintenance, right? Because you constantly have people coming in and out, and sometimes the people that come in there, maybe they're younger and they're not as respectful to the property. And so you could see that maintenance can be higher. The passive experience can be lower, right? And you're having more conversations with the property manager and you're paying a little bit more money for maintenance here and there. So, you also have to constantly worry about keeping it rented and holding your property management service accountable. And that's why with our vacation rentals, we really like the fractional model versus full ownership, because you have a group of people there and that own the property, and it's like partners that own it. And so when there is maintenance expense, it's not just coming out of your wallet, it's coming out of a group of 9 others or 5 others, 4 others wallets, so that's kind of a way that we can make the experience a little bit more passive for you and a little bit more affordable. Vacation rentals, I think, is a great way to kind of get your feet wet in the rental property market and the opportunities that are available to you with rentals. Definitely. And it's also pretty cool that you can use it yourself, right? Whereas if you own a rental property in St. Louis, you might not ever even visit it. You're sure as heck not staying in there and living in there. So, a vacation rental is a great way to kind of get started, learn about the business, but also kind of reap the benefits yourself. And the final thing that final tip I would give you is to consider private lending. This is a great way to get involved in real estate deals, bigger deals, and a great way to see high returns, double-digit returns, 12%, like I said, on our current offerings. So, rental properties right now in today's market, and especially with the finance, it's not going to get you 12% returns on cash flow. And so if cash flow is your main priority, private lending is a great option. Now, this is kind of like investing in a REIT as well, but it's a debt syndication. You're lending debt on a larger project, but it also gives you the opportunity to review the PPM, review the details, educate yourself on what are good deals, what aren't good deals, and it makes you feel a little bit more involved in what you're investing in. And it's a great way to kind of build a relationship with a group out there that, hey, if you find a company that's, continuing to prove out, finding good deals, getting you paid back in a timely fashion, when they promised or maybe a little early, that's a company you want to hold on to because they can make you a lot of money. I mean, imagine if you could just making 12% on your money every year. It'd be great in a really passive manner too. Kind of like the role of the bank, just collecting a monthly dividend, not having to deal with vacancies and maintenance and things like that comes with rentals. So that's a really, really good way to get started as well. You have some money in an IRA, a 401k that you can access. That's a great way because then the dividends are going to come back to you tax-free or tax-deferred. You got to self-direct the account first, though. So if you haven't done that, look into it. There's a lot of companies out there. Just type in self-directed IRAs, or IRA companies, custodians, and there'll be a ton that pop up. Call them, speak with them, interview them, find out the best one to work with. Get that money into a self-directed account. You can start lending that money out. Those dividends come back tax-free or tax-deferred. That's great. If you have some cash laying around, don't know what to do with it, sitting in a savings account, not doing anything, sitting in an annuity, not doing anything, sitting in the stock market, and it's going up and down and all around, consider private lending. It's a great way, like I said, to get involved. And you're going to be dealing with commercial real estate investments, typically commercial buildings, building commercial buildings, buying value add commercial buildings, retail space. So you're dealing with some bigger deals that are just a little bit more exciting. just can actually provide you with a much more passive experience and pay you double-digit returns, which everybody's looking for. Double-digit fixed returns as well. That would be my final tip I'd give you. For those of you that are listening to the show, if you like the information that I gave today on today's episode, you can go to realestatecowboysdfw.com, listen back to old podcasts that we've had. And you can also go on to iTunes, subscribe to our podcast, Real Estate Cowboys, and you'll get alerts every time a new episode pops up, which is it's every Sunday. If you're interested in kind of digesting a lot of the information that I give each week on the podcast in a quick read, you can buy my book, The Passive Income Guide, What's Your Return on Life? You can get that on Amazon. It's a very affordable book, lots of information in there. The price to get the information is just very, very cheap, I would say, very inexpensive, because there's a lot of great info in there for beginning investors and a lot of great info for even seasoned investors who want to go the more passive route and learn more about the passive options that are available to you and learn about, how to avoid pitfalls when investing with turnkey providers, turnkey companies, turnkey rentals, or with private lending, or the self-directed IRA 401k process, or investing in vacation rentals or vacation rentals outside of the U.S. Don't think that you're just stuck to the U.S. when it comes to investing. Diversifying outside of the country a lot of times is smart if you have that kind of money to do so. So I recommend reading that book. And, also there's tons of information on our websites, realestatecowboysdfw.com. You have a lot of information there, our blog. You can also go to AREIUSA.com, which is American Real Estate Investments website. That's also my company. And there's tons of information on there as well. If you're interested in getting involved in any of our opportunities, just put your information in on either one of those websites and our contact page, and a member of our team will reach out to you and let you know what type of opportunities we have available right now. Getting on our list is a great way to get exposed to new opportunities as they become available as well through an email. So a lot of investors like to just stay up to date on our mailing list. Go to either one of those websites, put your information in, and you'll be on our list. Thank you for tuning in this week. Always a pleasure. See you next week, and remember, what's your return on life? This is John Larson signing off.
All opinions expressed by the hosts of the show are the opinions of American Real Estate Investments, LLC, and do not reflect the opinions of guests or sponsors. No personal or professional advice heard on this program should be considered an endorsement to follow a real estate financing or investment strategy. Before acting on any information, seek advice from your financial, tax, mortgage, or real estate advisor, as the information is not guaranteed and investment strategies have the potential for profit or loss.